Fund flows year to date have been fairly spectacular, but Tom notes that these flows have not been exclusively towards equities. In fact, there have been some relatively cautious destinations as well.
We've seen about $779 billion come into the fund business. That includes both the conventional funds as well as ETFs. But when we're taking a little deeper dive into that, we see that a lot of the money has actually still been going into very conservative asset classes rather than the go-go funds that we thought probably would be there, considering we've had a 11.5% return year to date. So what we've seen is taxable bonds taking about $241 billion. We see muni bond funds have taken about 44.7, and money market funds have attracted $296 billion, while equity funds have taken in 197.7. Good numbers, but a little bit lopsided. We would have thought that people would have probably gravitated towards the equities more diligently than they have let's call it the safe haven plays.
Over the last decade, flows into equities have been fairly stop-start affairs, with many years actually registering outflows. Therefore, 2021 does look relatively impressive on that metric.
The numbers are looking pretty strong for equity funds. When we take a look at this, $197.7 billion net new money coming in all the way through June 2nd, 2021 is certainly something to write about. We haven't seen those type of inflows since 2014. So, but the story is a little bit different if we're taking a look at this, because it hasn't just been all equities as we would have thought of. And in fact, if we take a look at the breakout of how this has been had, we see that there's a big story, a tale of two cities, if you will, between ETFs, equity ETFs is that, and conventional funds.
For equities in particular, the flows have been split by manager type between active and passive mandates, as well as a large split by style.
First of all, we've seen massive outflows continue for the conventional funds. And when I say massive, 98 billion outflows, if you will, year to date. But on the ETF side, on this equity universe, we've seen $295.8 billion. So when I gave kind of the high number, $197.7 billion, very strong return, 11.05, it has not equated to fund flows into conventional funds, but primarily into ETFs. And how this is broken out, if we take kind of a greater focus on this, we see that investors are actually changing. They're doing rotation. We've been talking about rotation for quite some time. And what I mean by rotation is we all know that the stay-at-home stocks and the tech stocks, the FANG stocks, were very popular last year and even into the first part of 2021. But what we have seen is investors taking money and putting it into areas that have underperformed. So to your point, international, we've seen international equities taking about $77.6 billion, easy for me to say here, on the ETF side, but they've actually handed it back about 35.7 on the conventional fund side. So total, we've seen about $41.9 billion go into equity, but on the international market side. That trend actually continued into other unpopular asset classes. Small cap funds, which were out of favor in the entirety of 2020, have now been a main attractor of investors' assets, about $38 billion coming into that group. Not quite as lopsided here. We see ETFs took in about $25 billion. We see conventional funds took in about $13 billion. So the numbers look good there. But another trend we have seen is that rotation into, we call it sector other in the kind of the macro group sense, but commodity funds. We all know the commodity prices have been skyrocketing, really going up quite a bit. And we see that sector other funds have attracted about 21.6 on the ETF side, about 9.5 billion on the conventional fund side. So certainly doing that. But one of the stories that I do want to point out is I told people we've seen money go into large cap funds. About $11.8 billion have gone into large cap funds. But here is where the story changes. 187 billion of those inflows actually came from ETFs, while 75.3 billion have been outflows from large cap funds from the conventional fund business. So this has been quite the story, and a story we've been talking about for some time.
The reasons for these splits appear to be in part motivated by the generational need to diversify and reduce risk ahead of retirement, despite the positive momentum in equities.
With large cap funds, we have people that have been putting money to work for years upon years, let's call it the last 20, 30 years, and have been told on a core and satellite basis to put their money into large cap funds. So I don't think this quote that I told you, people have been redeeming from large cap funds. I think they found two things. first of all, there is the ETF advantage. There is low-cost providers and the like. But secondly, there are people that are going towards their retirement years that all of a sudden woke up and said, I've got 80% of my assets in large cap funds, and their advisors are telling them two things. You need to diversify, and not only do you need to diversify, but you need to go into other asset classes. So it's not just like buying other large caps, but you need to buy the bond funds. You need to have international in your portfolio. You need to have REITs. You need to have other asset classes that are basically diversified and non-correlated, or at least lower correlated.
The generational needs as well as the current growth opportunities are therefore splitting flows towards both defensive mandates as well as more aggressive equity opportunities.
We're actually seeing a bit of a change on the side of moving towards the equity market, moving more towards the aggressiveness. Now, that said, we are still seeing money into money market funds. Flows into money market funds are a counterindicator, right? People just don't know where the market's going. But it's ironic that we're seeing these flows go into, remember, the Fed has been talking about, yes, we're going to keep easy money. No, we're going to cut back on our asset purchases. But we all know that inflation is starting to look like it's rearing its ugly head. But people are still pounding money into that taxable bond fund category. I think that's a carryover. I think that's with automatic monthly investments. But we are seeing this change into outer rotations, into a different rotation, into more risk-seeking assets, small cap, commodities, those that show kind of a continuation of expansion of the economies.
Overall, the positive flows look set to continue through the year and should remain supportive. Whilst the last year has highlighted the rise of the millennial investor, these fund flows are also a reminder that baby boomer flows are more conservative in nature. If growth expectations subside, the net effect on flows could be the shift away from equities by retirees.